second part of the presentation for Chapter 17, Investments. In this learning objective, we will consider some other major issues related to investments in debt and equity securities. As we mentioned in the presentation for Chapter 14, the FASB allows for fair value reporting for most financial instruments, with gains and losses reported in income. Instead of the portfolio method of fair value reporting that we discussed in the first presentation, this option is applied on an instrument-by-instrument basis. The fair value option must be chosen when the security is first purchased, and then it is applied until the company no longer owns the investment. To illustrate the fair value option for a debt security, we will consider Hardy Company that purchased bonds of Fielder Company during 2020 that are classified as available for sale. The cost of the securities was $100,000 and the fair value at December 31st, 2020 is $125,000. If Hardy chose the fair value option for the Fielder bonds, then it would record an adjusting entry for the change in fair value on December 31st, 2020 by debiting debt investments for $25,000 and crediting unrealized holding gain or loss income for the same amount. Notice that when the fair value option is applied on an instrument-by-instrument basis, there is no fair value adjustment account used. Instead, the adjustment is made directly to the debt investment account, and the unrealized holding gain or loss is to net income instead of other comprehensive income. To illustrate the fair value option applied to an equity investment, we will consider Durham Company that owns a 28% stake in Supon Inc. purchased for $930,000 in 2020. At December 31st, 2020, the fair value of the investment is $900,000. To record the adjusting entry if the fair value option was elected, Durham would debit unrealized holding gain or loss income for $30,000 and credit equity investments for the same amount. Companies are required to record impairments in their investments at year-end when it is probable that the full amount will not be collected. When an impairment occurs in held-to-maturity debt securities, the investment should be written down to the fair value that the company expects to collect. To illustrate the recording, we will consider Strickler Company that owns held-to-maturity bonds with a par value and amortized cost of $1 million and a fair value of $800,000. Strickler would record the impairment by debiting allowance for doubtful accounts and crediting debt investments for $200,000. The entry to record the loss on the impairment would have already been recorded. Companies that hold debt investments that are classified as available for sale must consider not only the possible impairment on the investment, but also the fair value. The reason for the distinction is that if a company thinks it is probable that an available for sale investment has been impaired, it can sell the security to limit its losses. Therefore, when determining the entry to be made, the impairment loss that is recorded in income is limited by the difference between it and the fair value. This concept will be illustrated in the next slide. This slide illustrates impairment recording with three different fair values that could occur with available for sale securities owned by Alexander Company with an amortized cost of $1 million and expected credit loss of $110,000. In the first scenario, the fair value of the bonds is $1,100,000 above the amortized cost. In this case, no credit loss would be recognized in net income, and an unrealized holding gain would be recorded to other comprehensive income of $100,000 because the fair value is greater than the amortized cost. The second scenario B has a fair value of $960,000. In this case, the loss that is recognized in net income is limited to $40,000, the difference between the fair value and amortized cost. The last scenario C, the fair value is $860,000. In this case, the full $110,000 credit loss would be recognized in income, and an additional $30,000 loss would be recognized in other comprehensive income. Again, this accounting reflects the expectation that credit losses on available for sale securities can be limited by selling the securities. Another issue involves the double counting of realized gains and losses on available for sale securities when the securities are sold. Net income is a part of other comprehensive income. Therefore, the unrealized gains and losses that are already part of other comprehensive income must be reclassified when the securities are later sold. As we discussed in the first presentation, companies adjust the value of available for sale securities portfolios at the end of each reporting period. The unrealized holding gains and losses are included in other comprehensive income instead of net income. Therefore, companies that sell available for sale securities have to reclassify any previous unrealized holding gain and losses for those securities already in other comprehensive income when the securities are sold to avoid double counting the realized gains and losses included in net income in the current period. The FASB prefers that the reclassification adjustment be shown in accumulated other comprehensive income in the notes to the financial statements. For example, a security that had a previous unrealized holding gain of $25,000 recorded in other comprehensive income and now included in net income would need to show the subtraction as shown in this slide. In this learning objective, we will describe the use of and the accounting for derivatives. There are different types of derivative instruments, but they all derive their value from the values of other assets. We have previously studied a derivative when we covered stock options in Chapter 16. If you remember, the value of the stock options was based on their fair value on the grant date. The fair value was determined using an option pricing model, which includes the underlying value of the stock. Other types of derivatives that are commonly purchased by companies are financial forwards and futures, which we will illustrate in the presentation, and interest rate swaps, which your text illustrates. One common use of derivatives is to protect against changes in the market price of commodities. Commodity prices are subject to volatility because of conditions beyond the control of either the producers or the consumers. However, both need to plan their operations so that they can earn a profit. To do so, they enter into derivatives to set the future revenues and costs at which they know that they can operate their business successfully. Proper use of derivatives is part of the risk management of large corporations, but can also be used by small companies and producers to hedge transactions. Other groups also speculate in the derivatives market to earn a short-term profit, or arbitrageurs may have transactions in two or more markets simultaneously to exploit small inefficiencies. Both groups are important to the markets because they help to keep them liquid. The basic principles in accounting for derivatives states that derivatives are recorded at fair value. Gains and losses from speculation are reported in net income, and gains and losses from hedging transactions are reported in either net income or other comprehensive income, depending on the type of hedge that the company is using. We will learn about both speculating and hedging transactions in the next slides. To illustrate accounting for speculation in derivatives, we will consider Baird Investment Company that decided on January 2, 2020 that it would purchase a call option for $400 to purchase 1,000 shares of Laredo stock at an option price of $100. The call option will expire on April 30, 2020. Call options are purchased when you believe that the price of the underlying stock will go up. Baird will not make any money on the option unless the price of the Laredo stock increases above $100 before April 30, 2020. It is also important to remember that Baird is not required to purchase the Laredo stock at all. Baird will receive net settlement at the time of the exercise of the options for the difference between the option price of $100 and the market price times 1,000 shares, the notional amount. To record the purchase of the call option, Baird would debit call option for $400 and credit cash for the same amount. There are two components for every option premium: the intrinsic value and the time value. At the time that Baird purchased the call option on the Laredo stock, the intrinsic value was zero because the option price was $100 and the market price was the same. The call option, however, had a time value, which was equal to the $400 option price paid by Baird. The time value represents the value that the option seller places on it based on their assessment that the Laredo stock will increase before the option expires on April 30th. The market price of the Laredo shares did go up to $120 per share on March 31st, 2020. At this time, the intrinsic value of the option is now equal to $20 times 1,000 shares, the notional amount, or $20,000. The time value of the call option is now $100, which reflects that there is less time before the option expires on April 30th. Before the option expires, the market price declines to $115 per share on April 16th, at which time the time value is $60. Baird chooses to exercise the option at that time. Baird's recording of these entries will be shown in the next slides. On March 31st, Baird would debit call option for $20,000 and credit unrealized holding gain or loss income for the increase in the intrinsic value, and debit unrealized holding gain or loss income for $300 and credit call option for $300 for the decline in the time value of the option from $400 to $100. The call option would be reported at fair value of $20,100 on the balance sheet, and the unrealized holding gain or loss would be reported in the income statement. On April 16th, Baird would record the unrealized holding loss for the $5,000 decrease in the intrinsic value since the market price dropped from $120 to $115 by debiting unrealized holding gain or loss income and crediting call option for $5,000. To record the decrease in the time value, Baird would debit unrealized holding gain or loss income for $40 and credit call option for the same amount. On April 16th, Baird exercised the call option and received $15,000. The entry to record the settlement would be a debit to cash for $15,000, debit to loss on settlement of call option for $60, and a credit to call option for $15,060. This slide shows the total effect on Baird's net income for the purchase of the call option on the Laredo stock. The net income recorded for the option on March 31st, 2020 was $19,700, and on April 16, 2020 was $5,040. At final settlement, the remaining $60 cost of the call option was written off. Thus, the overall effect on net income was $14,600. In this learning objective, we will explain the accounting for hedges. As we discussed in the previous slide, derivatives are used as part of the risk management strategy corporations use to hedge against the impact of changes in commodity prices, but also for changes in interest rates or foreign currency exchange rates. Two types of hedges that companies use are fair value and cash flow hedges. We will discuss the special accounting that is used for each in the next slides. One use of derivatives is to hedge or offset the exposure to changes in the fair value of a recognized asset or liability or an unrecognized commitment. If a hedge is perfect, the gain or loss on changes in the fair value of the derivative equals or offsets completely the change in the fair value of the hedged asset or liability. To illustrate the use of a derivative in a fair value hedge, we will consider Hayward Tire Fabricators, Inc. that holds an inventory of 1,000 tractor tires with a cost of $200 per tire. The current value of the inventory is $200,000. Because the inventory is pledged as collateral for one of its bank loans, Hayward wants to hedge its exposure to fair value declines. To hedge the risk that the value of the tire inventory will decline, Hayward wants to lock in the value by purchasing a put option to sell rubber at a fixed price. When a company believes that a value will decline, they purchase a put option rather than a call option. In this case, Hayward is concerned that the price of rubber will decrease in the future, which would negatively affect the value of the tire inventory. The put option value will increase in value if the price of rubber declines, opposite to the tire inventory. Thus, Hayward designates the purchase of the put option as a fair value hedge for the inventory. The put option gives Hayward the option to sell 4,000 pounds of rubber at a price of $50 per pound, which is the current spot price for rubber in the market. Since the exercise price and the current market price are the same, there is no entry at the inception of the put option. On March 31, 2021, the fair value of the inventory has declined by 10%. Under fair value hedge accounting, Hayward is allowed special hedge accounting for the inventory. To record the decline in the value of the inventory, Hayward would debit unrealized holding gain or loss income and credit allowance to reduce inventory to fair value for $20,000. Hayward would also record the increase in the fair value of the put option by debiting put option for $20,000 and crediting unrealized holding gain or loss income for the same amount. The balance sheet would show the fair value of the tire inventory of $180,000 and the fair value of the put option of $20,000. The income statement would include the unrealized holding gain on the put option of $20,000 and the unrealized holding loss on the inventory of $20,000. Thus, the purchase of the put option was successful in hedging the decline in the value of the tire inventory. Derivatives are also used to hedge exposures to cash flow risk, which result from the variability in cash flows. The reporting of cash flow hedges requires reporting the derivative at fair value, with any unrealized gains or losses on the derivative reported as part of other comprehensive income. To illustrate the accounting for a cash flow hedge, we will consider Allied Can Company, which anticipates in September that the price of aluminum will increase, and in order to hedge for an anticipated purchase in January 2021, enters into an aluminum futures contract that gives Allied both the right and obligation to purchase 1,000 metric tons of aluminum for $1,550 per ton. The contract price is good until January 2021. The contract price on September 1st, 2020 is equal to the spot price for aluminum, so there is no entry needed to record the contract. On December 31st, 2020, the price of aluminum has increased to $1,575 per ton. Allied makes an entry to record the increase in the fair value of the futures contract by debiting futures contract for $25,000 and crediting unrealized holding gain or loss equity for the same amount. The gain is equal to the difference of $25 per ton between the contract price of $1,550 and the current market price of $1,575 times 1,000 tons. The futures contract would be reported as a current asset, and the gain would be reported as part of other comprehensive income. In January 2021, Allied purchases the 1,000 metric tons of aluminum for $1,575 per ton and debits aluminum inventory and credits cash for $1,575,000. At the same time, Allied settles the futures contract by receiving cash of $25,000 and crediting futures contract for the same amount. Allied has successfully hedged the cash flows for the aluminum purchase as shown on this slide. The aluminum purchase was $1,575,000, but Allied received $25,000 on settlement of the futures contract to keep the price per ton at $1,550. At this point, there are no effects on net income because the unrealized gain on the futures contract is in other comprehensive income. Allied produces the aluminum cans and sells them for $2 million. The cost of goods sold is $1,700,000. To record the sale in July 2021, Allied would debit cash for $2 million and credit sales revenue for the same amount. It would also debit cost of goods sold and credit inventory for $1,700,000. Allied would also debit the unrealized gain or loss equity for $25,000 and credit cost of goods sold for the same amount. The gain reduces the overall cost of goods sold in the income statement to $1,550,000. In this learning objective, we will discuss one of the special reporting issues that is related to derivative financial instruments. When we discuss convertible bonds in Chapter 16, you may remember that there is a debate as to whether there should be a liability and equity component recorded for convertible debt that a company issues. There was a similar issue for convertible debt that a company owns as an investment. The FASB now requires that a company bifurcate or separate the conversion factor, which is called an embedded derivative, from the host security, which is the bond, and report the embedded derivative at fair value. An alternative to bifurcation is to report the entire convertible bond at fair value. In this learning objective, we will describe required fair value disclosure. Companies are required to report both the cost and fair value of all financial instruments in the notes to the financial statements. The FASB has decided that additional information regarding the determination of fair values, including the inputs used to determine them, should also be reported. There are 3 levels of reliability of fair values reported in the financial statements. Level 1, which is the most reliable, is based on quoted market prices in active markets for identical assets and liabilities. An example of a Level 1 fair value would be to use the current selling price of an identical bond or stock in the market to determine the fair value of the securities that the company owns. The next Level 2 is less reliable because the fair values are not based on identical assets sold in the market, but only similar ones. An example of Level 2 would be if the bonds that the company owns are not sold in the market, but similar bonds to the ones owned are used to determine the fair value. Level 3 is the least reliable. This level is used when there is no identical or similar assets sold in the market. These values are based then on unobservable inputs that cannot be verified and reflect assumptions that the company makes as to the value of the financial instrument. Level 3 is often used to value derivatives such as interest rate swaps where there are no active markets. These are the quiz hints for Chapter 17. Please make sure that you have completed the homework prior to attempting the quizzes. This is the information on the problems for Chapter 17 that will be included on the exam. And this is the end of the presentation for Chapter 17, Investments.